Welcome to Money Convos, where we discuss personal finance and investment tips. We're committed to helping people create wealth and achieve financial freedom. Follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. All right then, let's head into today's conversation. Hi, I can hear you.
Okay, great. Hi,
Hello?
Brian. How you doing?
I'm doing well. How are you?
I'm great. Okay.
Hello.
Since you joined first, you were made the moderator. Kindly make me a moderator. Tap on my profile and make me a moderator.
Okay.
Yeah.
Kojo, it's been a while. I hope you are doing well.
Okay. Brian, I'm still waiting on you.
Yeah, I'm tapping on your profile, but there's no option.
Oh, okay. I see. Interesting. Okay, we'll circle
Should I
back on
leave
that.
so that you add yourself and then I add back?
Okay. Let's try this one more time. So when you tap on my name, the options that pop up at the bottom, there should be make moderator.
I see invite to speak.
Oh, interesting. Oh, wait, that's odd. Because I'm already up on stage. Okay, you try this. You exit and re-enter. And let's see
Okay,
how
I've
that goes.
seen make a moderator. Let me add that.
Okay, great. Thank you.
Sure.
All right. So welcome everyone to today's conversation. We are talking about loans. We're talking about loans today, and the next week we'll also talk about a loan, but it's special. It's a mortgage, and after that, I guess you are getting where the drift is going. We are going to talk about getting a house. So it's an interesting series of conversations we are going to be having for the next couple of weeks. Oh, I took Jennifer to the audience accidentally. Jenny, please come back up stage. Yeah. So it's an interesting series of conversations we are having, and today we are honored to have a banker in our midst. For the sake of maybe some kind of confidentiality, we may not mention his institution, but it's one of the top banks in Ghana. We don't want to mention it because these institutions, unless you are cleared to speak on their behalf, we just want to make sure that there are no ambiguities, so that you know that he's not speaking on behalf of his institution. So, Brian, welcome on stage. If you don't mind, tell us a little about yourself, as much as you can share.
Thank you very much. I'm honored to be here today to speak with you. My name is Brian. As Elikem said, I'm a banker by profession. I've been in this business for close to 5 years now, I believe. I studied banking and finance at the university level, and I did my national service with a bank, and then I got a chance to join a different bank as a graduate trainee, and then ultimately I got employment within that bank. So that's what I'm currently doing. I'm currently a relationship officer, but then I work with credit management as well. So I guess that's why I was asked to come and join the conversation, since we'll be speaking about credit issues. So once again, I'm honored to be here. Thank you for inviting me.
Great. It's an honor to have you join us. Okay, so guys, you've heard a little about Brian. He's not a small boy cry. He joined the management trainee program. Just say those ones are the way they hire the sharp brain people. Oh. They don't just take them as entry level people. No, they call them management trainee people. Yeah. So he's a big man in our midst. Future CEO or future MD of a bank. Amen to that. And thanks to Jennifer for doing the connection. So thank you so much for bringing Brian on board. All right, so we don't have too many people on stage, but my first question I would have asked is there anyone here who has not taken a loan before? Perhaps let me start from like a loan from a financial institution, because I'm sure that everyone, one way or the other, has told someone, Charlie, wire me something, make I send you something back. right, later. I'm sure we've all done that. But I'll be intrigued to know if no one has ever done that. But let's start from the financial institutions. Brian, I'm curious, although you work in a bank, have you is it a situation that you have never taken a loan before?
Well, for myself, my first time I've ever taken a loan facility um, is with my current employers. Before then, I was a bit averse to taking any form of credit at all. I'm not a fan of owing. So, this is actually my first time. I currently service a loan with my institution. So, yes.
Nice, nice, nice. So, since you were so averse to loans, just out of curiosity, what made you say, you know what, this time I'll take it?
The honest truth is, the terms of the facility that were available were very, very attractive. I didn't 100% need it, but then the offer was. So it's one of those offers where you are doing yourself a disservice if you don't take it because it's freely available, and so that's more of the reason why I took it. Not that I necessarily needed it at that point, but I think we'll be
Yes.
getting more into details later on.
Yeah, yeah, it's a good point you've mentioned, and I wanted to draw attention to that. I had that suspicion, and same thing with me. When I also started working in a financial institution, I had an opportunity for an auto loan, so I just refinanced my car and or upgraded it to while I was at it, and pocket and kept the rest in the bank, right? And it's a good opportunity because if it is being given to you at favorable terms, that's effectively money that they are giving you. So if your colleagues are taking that opportunity and even just putting the money in an investment to earn some return, that's just extra money that your colleagues are being paid that you are not being paid. So you may want to take advantage of those opportunities. Jennifer, how about you? Have you taken a loan before?
No, please. So I
Hey,
haven't taken an official loan before,
okay.
but I hope to break my quote unquote loan virginity in the
Uh,
coming year or next. So it's a good place that I've come. I hope to learn. Yeah.
okay, okay. Yeah, we are going to learn how to break your virginity very safely. Okay, interesting one. But I think I can attest. I think Jennifer has borrowed 5 CD or 10 CD from me before. She paid it back, in case you're wondering. So
Mm,
I can vouch for her credibility. David, how about you? You are in an entirely different market from ours, where loan interest rates are very low single digits. Nice, nice. Have you taken a loan before?
Have I? Yes. I'm sitting on a few of them right now, Cry. But I think somebody was saying it before when I came on. Sometimes when, especially for us, when the rates are so low, you just, it makes a lot of sense for you to just go ahead and do it.
Right.
So yes.
Okay, that's a good one. When the conditions are so good, you just go ahead and take it.
Mm-hmm.
Okay, great. Thank you. So let me not assume anyone. Oh, in fact, this would be strange. Is there anyone here who has not taken a loan from even a friend or a family before? Show by hand or by flash of mic. Okay, all right. Everyone has done some small lending before, but if I look at a free year in the audience, Michelle, she's not borrowed from anybody before in her whole life. The way she is, nah, she hasn't. Go ahead. Okay, all right. Anyway, so before we enter the crux of the matter, I see some very familiar faces in the audience. Nice to have you all here. We are talking about loans today, and we have a banker in our midst, Brian, and he'll be sharing some experiences and lessons for us to help us know what is a good loan to take, how do we prepare to take a good loan, and while we are at it, understand all those terms and conditions and make sure that it's a good experience for us and it wouldn't be a bad one that will say that maybe I'll never owe again. I think on Money Convos, we've talked about using other OPM, other people's money. So let's see how we can take loans to use other people's money in a good way. All right, then. What is a loan? Brian, can you tell us what a loan is? Let's not assume everyone knows what a loan is.
Awesome. So A loan is basically an advancement of funds that's given to one party by another with a promise to return the funds at a set date with an additional, should I call it an additional premium, which we call interest. So it's basically one party borrows from another with a promise to return the funds at a future date which has been set amidst certain conditions. And then when you are returning the funds, of course, you return it with a little premium just to compensate the lender. So that's basically what the loan is.
Nice, nice. A little premium to compensate the lender. So when you said a little premium, I'm sure we'll get into interest rates in a bit, but I'm sure the people who have taken loans at 40-50% effectively, I don't think they consider it was a little premium. Have you seen any such experiences before where people were borrowing at 40-50%? Perhaps not with your institution.
Definitely. So there are different categories of financial institutions who lend to customers, and most of the larger institutions, that's the commercial and investment banks, they have the luxury of lending to customers at very attractive interest rates, whereas most of the smaller institutions who may have to take up more risk in lending to the same set of customers are more or less pushed to lend at higher interest rates just to compensate for the kind of risk that they are taking in lending. So some of the rates are, I agree, they are on the higher side, but it depends on the category of institution that your company falls within.
Interesting. That's a good point, and a segue into the different types of institutions that we can go and borrow from. But before we dive into that, Jenny, you want to say something, and then we welcome Mimi onto the stage. Jenny?
Okay, so I once heard of somebody who was getting a loan. I won't mention the institution's name, but it's on the lower end, as Brian stated, and the loan was being serviced at 46%. That's almost half. Yes, thank you.
Oh, when I hear of such rates, usually it doesn't hit people that it's 46%. Were they showing the person the interest rate like on a monthly basis, so like 6% a month, or like did they do it monthly, or they actually wrote it in the contract that it's a per annum rate?
So I heard it from the person who had gotten the loan, so he knew what he was getting into. Yeah.
Oh, okay. Interesting. All right. In my experience, when I hear of such rates, it's usually a per month charge. So 6% per month effectively goes up to what? 6 times 12. Oh boy, the brain is too slow. Yeah, 6 times 12 gets up to 72, right?
72%, yeah.
72%, yeah. But usually those are even maybe a 3-month loan or something. Interesting. Okay, great. Hi, Mimi. Welcome on stage. How you doing?
I'm doing well, Eddie Kim. How are you doing yourself?
I'm great. So we are asking everyone, have you taken a loan before?
Yes, I have taken a loan before.
Oh, okay. That's good. All right. Great. Okay. We'll circle back to you in a bit.
Sure.
So back to Brian. You started talking about the types of institutions that people can go to for loans, right? But before you determine which type of institution you are going to for a loan, does your need for a loan matter? So in other words, what are the reasons why people take loans, and does it influence where they should go for loans from?
Yes, definitely it does. So basically, as the in the most basic sense of the word loan, you need a cash advance or you need some form of credit advance that you do not or you may not readily have available at the moment that you need it. So you will go to a lender and take some funds from the person or take something on credit from the person with the promise to pay back at a later date. Now, when the urgency of the facility you need, you put it into context, it may have a huge impact on who you would go and borrow from and which interest rates you are likely to accommodate in the loan contract or in the loan arrangement that you are willing to sign up to. So I think agency plays a key role in determining who you are ready to borrow from.
Interesting. So, does that mean like the people who are ready to give loans, let's say like within 24 hours, I see those adverts. Does it mean that those people are more likely to charge you a higher rate because they know that, Charlie, you are hot?
Yes, yes, to a large extent, that's the situation. We have a running joke in the industry that I work in that there are some institutions that they drive around with boxes of money literally in their vehicles together with their laptops. So they meet you at your institution or they meet you outside. They take a few details from you and then they make you sign a document. Then instantly they just take a bundle or two from their box and then they hand it over to you. But as you are entering into that contract, you must be wary that it has implications. So you may be getting your money much more quickly than you would if you go through an institution that will have to go through a longer KYC process or credit management process. But then, as I said earlier, it boils down to the agency. If the money, you need it almost instantly, you will be willing to do, in my experience, I've realized that some people will be willing to sign literally anything you put before them just to have access to the money to solve whatever pressing need they have before they even think of the terms that they have signed on to later on.
Interesting. When you are very desperate, you just grab anything. Okay, all right. So I've heard about institutions like, I know we have the universal banks. You work in a universal bank. Then there are is it specialized deposit taking institutions. There are the non-banking financial institutions. We have the savings and loans. We have the microcredits, rural banks, and yeah, there are also credit unions. Yes, there are credit unions, and I think there. Susu, well, I guess Susu wouldn't necessarily work as a loan, but some of these names, these terms that I've mentioned, how are they different? How do they vary in terms of the kind of loans you can get from them?
Okay, so as you've rightly said, in fact, most of the categories of institutions that you were mentioning was just bringing me back to business school days where we had to memorize some of these names and then what an institution should qualify for to be able to fall within those categories. Yeah, so thanks for bringing back those memories. Now, basically, the size of the institution determines the category they fall under. So, as part of the list that you alluded to, we have the smaller institutions like the microfinance and credit unions who may not have a huge stock or a huge base of capital to lend as high as probably a savings and loans institution or a universal or commercial bank. So that being said, it almost naturally also translates into the fact that the larger the institution, the larger the stock of assets that they have that they can lend to different borrowers in order to be able to also make some returns on it. So most of the larger institutions are in turn able to lend more and lend at more favorable rates to the borrower. Yes, it's almost a direct relationship there.
Interesting. But I'm a layman. How do you perhaps you are in the bank, so you know which institution is a big one, which institution is a small one. So how do I know the difference between the big and the small?
Okay, so in the industry that I work in, the so to speak, the big industries or the big institutions would be the universal commercial banks. So we have the likes of, permits me to mention, you have the likes of ABSA Bank, we have the likes of Stanchart, EcoBank, Ghana Commercial Bank, National Investment Bank, SG Bank. We have different institutions that fall within this category. So with those institutions, they have there are requirements for you to be a customer in the first place. Secondly, for you to be a borrowing customer, there are some conditions that you should be able to fulfill. And then when you scale down a notch, we have the savings and loans companies. So we have institutions such as Bayport Financial Services. We have institutions such as Dalex Finance. We have institutions such as, sorry, a few of the names have escaped me, but I'm sure we are familiar with some of these institutions. We have the microfinance and microcredit institutions, which are also a notch lower than the savings and loans companies. Unfortunately, during the financial sector cleanup, majority of these institutions were, so to speak, merged. Some of them shut down, some of them closed down due to different regulatory breaches. And so a lot of them are not in operation today. But then in a couple of years back, we could make mention of, so almost to the extent that at any turn or any junction that you turn to, there is one microfinance or the other waiting to lend you money. And then we also have the much smaller organizations, the savings unions, the credit unions. That's basically association of people who form a union to lend and borrow from each other at agreed interest rates without necessarily having to go through all the paperwork of going to borrow from a universal bank or a commercial bank, so to speak.
Interesting. I like the term. The last one, I think, is not much heard about the credit unions. Can you shed some more light on it? Where can I go to join a credit union? Are the interest rates much bigger? Because are they much higher? Because I'm getting that people will come to an agreement and then they wouldn't necessarily come to an agreement to charge too much on each other. What do you think about that?
Okay, so with the credit unions, they are basically associations of like-minded people. They go ahead and form a union, which is usually backed by a constitution, where they lay out terms for each other that, assuming you have some excess funds that you don't immediately use, you can make it available by way of investment into the credit union, so that also those who do not readily have funds available but are in need of some credit lines can borrow from their colleagues at mostly agreed interest rates. And the difference between the rates that you are borrowing at and the rates that the credit union is lending to you at, that spread forms part of the excess income for the credit union. They can use it to organize credit union activities, support the members' welfare, etc. So it's basically what any financial institution would do, but at a much lower scale, if I can put it that way. Yes.
Okay. Interesting. I've heard about credit unions in church, in like employee unions where
Exactly.
employees will come together. Okay, all right, that's interesting. I've heard of quite reasonable rates over there, but I can imagine we have to delve into the details before you make a good decision about them, right?
Exactly.
Okay, all right. So now let me expand the gambit. My fellow speakers on the floor, I'm curious. Reasons why people have taken loans. And I was talking to another banker with another institution, and he was telling me about how some people just come to the bank and they want to take a loan. And you try to find out why they want to take a loan. And it's like, well, I finished school. I've also gotten a job. I have some money coming in. So I also want to take a loan. It's like a rite of passage because they've seen all the older people around them doing it. Then sometimes it goes further and say, oh, yeah, I have the money. So I can afford it. So you just give me a loan. I'll figure out what I want to do with the money. Or they want to now start living some kind of lifestyle, buy a car that perhaps they normally can't afford just yet. That kind of living. Have you heard of any such experiences, and what other reasons have you heard for people taking loans? Perhaps let's start with the ones that are not so good reasons or not so ideal reasons before we come for come at the good reasons why you may consider taking a loan. Anyone who'd like to go first? Mimi, have you heard of any reasons why people are going for loans?
I was trying to think. Yeah, I mean, I do know people going for loans mostly for right reasons. Okay, I mean that reminds me. So I think was it 2020, 2021? I had a call from a teacher, and he was in financial distress, or he was having tough times. So he called me to speak about it, and the whole issue was that he's a teacher, and most of the time it's teachers that and people in the public sector that end up living on loans. He's a teacher. His wife is also a teacher, and their parents both got sick. From both sides got sick. So to be able to finance that expense, they had to take loans, exhaust that how do I put it? Exhaust the total amount they can take from both sides. So right now their disposable income was very little, and looking at their budget too, there was no like want. Everything was a necessity. And I mean, he was discussing with me how they are struggling and what he can do next. At that point, it wasn't about the budget. He just had to generate extra income. That was the only thing that could have been done, because both he and his wife had taken maxed out their loan, and was making the home situation very uncomfortable. I think taking a loan, I mean, for health care, I mean, it's like it can be fine, but in the case where it's recurring, you paid for this person to be taken care of. Now the money is finished, the person is still sick, and you still have to be paying. Now you don't have any money, no disposable income to take care of the person. Then did you go or did you come? So I think that loans for recurring expenses like children's school fees, rent, and those things, I think they are quite bad, because you think you are solving the problem, but you are actually creating a bigger problem. So they may seem good on the surface, but I think that if it's recurring, you have to look at it again.
Interesting. I like how you've qualified the health one with recurring some way. But it raises an issue. Last week, Friday, I was having a sitting with some of my friends Friday night, and we were talking about money, how someone earlier that week had gone to borrow from someone to go and lend to another person. Bad idea. And we are getting into it, and it's like you don't have that money to lose, but you're giving it to the person. It's like the sad face the person gave her, and she was like, it's like I'm being callous or I'm not understanding who the kind of situation. But even that one cries mouth. My CEO has something that he says that even if your parents are sick, or your parent or family member is very sick, just pause and think about it. Now it's at this juncture that I'll just leave it to be ellipsis, and we think about this kind of scenarios. At that point, it becomes a very difficult situation, right? Maybe can we get to the bottom of it and say, okay, you know what? I'm sorry, but we are not going to take a loan to save your life. You know,
I
you may
think
not necessarily have to answer
no,
directly. Actually, what do
I,
you think?
I think that would be a tough one. I mean, to be honest, these are your parents. They're taking care of you. To you, I mean, a lot of Ghanaian parents will take loans to take their kids to school and all that. So it's like your turn to sacrifice. So I think it would be honestly difficult to say yes or no. But my whole issue is with the fact that it's recurring. So even after taking this, you've not solved the problem. The person is still sick and you're also stuck. But I think it's one of the, like, it's a very difficult decision. I don't think it can just be limited to just the financial part of it. I mentioned health insurance, national health insurance and all those things, but I can't remember whether he said he had exhausted that or not. But I think it's a difficult situation. I do think it's one of those difficult situations. Ideally, if we are just looking at the numbers, then the answer will be no. Yeah.
True. If we're looking at just the numbers, the answer would be no. But these are people who have sacrificed for us, so we have to make it work, right? And I like how you gave an out that you have to find a way to solve the problem sustainably. So after you take this loan, Charlie, you have to get on the grind, right? You have to see where are you. If you are a teacher, are you going to start doing some extra classes for some people? Because I know that some of these teachers are really grinding. They are teaching like 247. Yeah, you have to figure out another source of income because the payment there you have to make it right, but you have to find the income to make it sustainable. David, you wanted to chip in on this point?
Yeah, I was gonna say these things are, it's easier said than done. Especially when you're not in that situation, but when you're in it, it's a very tough thing to look at somebody and say that, you're ill, but then I will not be able to take a loan to help you get better. In my mind, the only time that argument is as strong as it could be is if the person's illness is a terminal one. Because, my helping you is not going to save your life. It's just going to make it temporarily feel, better. But you're going to, croak anyway. So if it's terminal there, Charlie, you're on your own. God help us all. But if it's not, it's very, very hard to say, I can't help you, with the loan, especially if you're in a position to be able to do that for them. So yeah, thank you.
Yeah, an untenable situation, Charlie. It's really, really tough one there. Really tough one. Okay, let's keep going with the reasons. So Mimi has given us some reasons, good reasons, and also some not so good reasons, like recurring fees, recurring school fees, rent, and you look at it the other way. Instead of taking a loan for it, why don't you flip it? Granted, you may have to work a little harder, get your income in order, and rather make it something you save towards. So you save towards your rent. The first payment, maybe the first time you had to do a salary advance, you took a loan, okay, and it's your rent is 500 cedis a month. As you are servicing the loan in your budget, put aside 500 cedis a month and let that go into an account that will be earning some return so that when the 1 year allowance is due, this time you have money saved up that you are going to pay the 1 year advance, so you don't have to take a loan again. That's another way to look at it. Some people buy phones on credit instead of buying the current iPhone on credit. Why don't you hold on, save up so that you buy the next iPhone with money that you've saved up? These are some strategies you can have. Otherwise, you may end up going to take a loan without the best of terms. But when you are doing it comfortably in a relaxed way, you can have the best of terms possible. Jennifer, Jennifer, how about you? Any other reasons you heard of people taking loans?
For a wedding.
Oh, this table that you are shaking.
Yes.
This table. Okay, please shake the table. Let's do this.
Yes. So the couple, I just know one couple that have done this, but apparently they know a lot of people, so it was very okay for them to do this. So I think they were going to get married and they didn't have enough for the lavish wedding the lady and her mother wanted. And of course, you know that in this part of the world, we have to show people that we are getting married. So they went for a loan, I think from Echo Bank. I don't know the nitty-gritties of the amounts that they took, but I think it was quite substantial. And they used it to marry. And they were expecting that the gifts and then the monies that they got at the wedding reception would be used to offset of the loan that they were going to pay. But sadly, this happened when we were in December. Lots of people already have expenses, so very few of them like dish out money like that in this. And it was also COVID, like yes, so they didn't get as much as they thought they were going to get. I don't know exactly how they got, but then they had to pinch themselves to pay. Yes, I remember. Yeah, so people took monies for weddings. Another thing, by extension, is also funerals, and apparently this is very prominent in Kumasi because when you take it, there's the notion that umbrella bonds, which means they will come and give you donations, and you use it to offset part of the loan. I heard from somebody that a lot of families do this, and sometimes umbaboka, which is they'll make a loss. What they thought they were going to get will not be able to get the loan that they went to take, and they'll spread the rest among the family members, the people that can pay, and then they pay it off.
Just say the funeral is an investment.
Yes,
Quick
please.
turnaround.
Very interesting.
Charlie, things are going on. Things are happening. Okay, maybe you wanted to jump in.
The way the families like.
Yes. Jennifer was saying that it was COVID December. Honestly, to me, I think that at any time of the year that you are tempted to do that, you should think twice. Because I remember when we were getting married, I didn't have any like expectations for gift or whatever. But I remember my husband calculating and doing his speculation just to be shocked by the amount. And I've heard this a couple of times. I think the only people who end up with a lot is maybe people whose parents are so big and people want favors from them, and it's like they are trying to pay something so that they'll look good. Or if maybe you yourself are in that position. But most of the time, even the people who you even say that, oh, this guy, he's a big guy, he'll pay, they are the ones who even pay. So I honestly think like it's a big mistake. If you're going to take a loan for your wedding, you should be looking at paying for it from your own pocket. If you are not excited about the idea, then I don't think you should go ahead with it. And what I did realize is when you are taking a loan, it's always exciting in the beginning to have some money that you've never seen before, credited to your account. So I know I'm jumping, I'm speaking too early, but I think that in order to make that decision, start living like maybe 3 months or 6 months as if you were living just on, your income without the loan repayment. And if you feel comfortable, fine. But if you don't, then maybe you should ask yourself again if this thing is worth it at all. Yeah.
That's an interesting point. David, sorry, just before you come in, I think Brian also wanted to say something on the wedding loans for wedding part. Hi.
No, I'll come in later on that. So let's proceed.
Okay, all right. David, please go ahead.
Yeah, I just wanted to ask Mimi and Jennifer that I'm thinking of doing a vow renewal, so I was gonna go get a loan, but based on what they're saying, maybe it's not a good idea. So, thank you for the advice. I'll cancel it. But
well,
so,
like I'll make a ticket. Like I'll
I just have the loan in the ticket, mama.
That's why I was gonna go get the loan, so that everybody who comes, free a ticket and everything.
Then it's a good idea, please.
And then I'll spend the rest of my life paying it off.
Please, all we're saying, we are now. We said it. We were lying. It's okay. Do the wedding and let's come and reorganize this session and
so speaking on the bad reasons for taking the loans, right? One of the things that I immediately thought of was what Mimi and Jennifer, you guys with the wedding stuff, was like taking a loan in anticipation of some money that you think you may or may not get. You never know how much it will be. You don't even know if it will happen or not. And then you go take a loan and then boom, something happens and you don't get what you thought you were going to go get, and then now it becomes a problem. For me and my environment, an example would be when like tax season is coming up, April 15th. People don't know what their tax return is going to be because they don't pay enough taxes during the year. So when they file their taxes, they end up owing, and they think they might get some big money. So they go take a loan out and then blow the money, thinking, oh, when my tax return come back, I'll pay it off. And then your tax returns come back and you're expecting $10,000 and you get $500. Meanwhile, you've already blown the money. Another example, people who take loans based on maybe a year-end bonus. Most of us, the year-end bonuses, it's not guaranteed. Like, the amounts are not guaranteed. It fluctuates. So you go take out a loan and then boom, that happens. I also personally feel like payday loans is not a good idea. I don't know if it's common in Ghana, but they take the loan and then once they get paid, they use that money to go pay it off. I feel like it creates a cycle of always being, hand to mouth, because you take the loan, the second that the paycheck hits your account, it's already, gone. So now you are back at square one. Now you're scrambling again. We've mentioned the wedding thing, so I wouldn't even say when you take a loan to just throw a party. That's also a bad idea. What else can I think of? Yeah, I think that's it for now. Thank you.
You know how sometimes we are, someone will say something and then another person will say it in a different way and go like, well, when you say it like that, David just said, take a loan to throw a party. And I'm like, okay, now when you say it like that, it's some way, right? Anyway, I think we beat that drum quite well today on taking a loan to do a wedding. So now we can look at some of the good reasons why people take loans. And I want to start off with, again, a conversation I was having with another banker, and he was talking about business. And it's sort of a mixed advice. So he's like, in his experience, he sees people wanting to take loans for business, and what he would encourage is, do this for your business. If you have a business that is already running, things are moving smoothly, and then you want to perhaps grow or expand the business, but not to take a loan to start a business, or you have a side hustle that is barely on its feet and you are going to take a loan that will be paid off by your main work's salary. That kind of thing will put you in a bad situation. But if it's a business that's already going and you need the money to just expand it, then that's a good reason to take a loan. Brian, what do you think of this?
It's a great point. It all boils down basically to personal preference. But I strongly believe, this is my personal opinion, I strongly believe that when you take out a loan facility or you take out any form of credit facility for that matter, the purpose for which you are using the money should do one of two things. It should either earn you additional income, or it should prevent you from incurring additional expenses. So I'm going to take them one after the other. So you can take a loan out to buy a vehicle. Let's say you work in, you are an HR officer in one of these organizations. You have a monthly income of 3,000 cedis, and you have your own vehicle. You are married. You have kids. You have a spouse who also supports with the expenses at home and everything. So you are in a typical middle class situation. You can take out a loan. Maybe you have your own vehicle that you drive to and from work. So you are okay. You can take out a loan to buy a small vehicle and give it to a trusted driver to run maybe one of these cab hailing services, so Uber or Bolt or Yango, any of them. You've taken money from a financial institution. You have more or less invested that money in an asset with the anticipation that it is going to grow in value, in that the car is not just going to be sitting there, but then whoever is driving the vehicle around is also going to be making income for you, perhaps to pay you off so that they can own the vehicle, or you will still be the owner of the vehicle, but then it will just be running and you are earning at least something little every month, part of which you can use to service the original loan you went to take. And at the end of the day, you are generally better off. So that's one example of taking a loan to invest in something that is going to earn you additional income. The opposite side of that is taking a loan and investing it in something that is going to prevent you from making additional expenses. So the same or similar scenario where this time you are maybe an entry level staff. You've been working for about a year. You feel it's about time you get yourself a vehicle that you can use to drive to and from work. Somebody may look at that and think, you're buying a car and you are not going to be using it for a ride hailing service. And so you are rather going to be buying fuel to service your car. So it's a bad idea. Not entirely, because in this case, you would have been still paying to transport yourself to and from work anyway. You would have been picking a taxi or picking church or any of the other means of transport to and from work. So there's still that recurring expense over there. But this time when you buy a vehicle, for all you know, the amount it will cost you to fuel that vehicle to and from work is going to be even less than half of what you spend picking an Uber to and from work every day. Factoring in other benefits that may not necessarily be monetary, for instance, the comfort you enjoy driving yourself to and from work, whereas you don't have to haggle over a seat on a public transport, or you don't have to sit next to somebody very sweaty early in the morning when you're on your way to a meeting. Some of these other benefits, I know it may come across as a bit classist, if you forgive me for that, but then it's a perk. It's a perk of having a vehicle and driving yourself to and from work, because you get to work, you are focused, you have a straight thinking cap on. You are not arriving at work already worn out from the means of transporting yourself to the office and back home. Sometimes when you close from work, you just want to just drive home or drive to your siblings' place, visit them for about an hour, and then go home, just go and relax. But then you now have to think of going to hassle for a taxi, joining a long queue, waiting at the bus terminal for about an hour. All these things are also costs. So when you take out a loan that you have the means to service and you use it for something that will prevent you from making additional expenses, I think it's also in order. But at the end of the day, it comes down to your personal preference.
Charlie, look, I think it's okay. We can close the show now. You said it all. Jenny, you want to jump on this point?
No, not Brian's point. When you mentioned that, when you asked the question, what came in my head was that, you see, when you go and take a loan from a bank, they are in the business of, they want money. They're not actually thinking about you like that. They're thinking about their profitability. So they expect that you start paying the interest very, very fast. So they can give you, let's say, a moratorium, which is some time to relax before you pay interest for, let's say, 6 months. That's very generous. But then from there, they expect you to start making payments. So if you are all looking to invest in something that you are now going to start from scratch and everything, which may not be able to generate income for you for even sometimes 1 to 2 years, it won't be a good idea to take a loan for that. So yes, thank you.
Thank you, Jennifer. That's a good point. They are standing there, Jinahoji. They need their money quickly, and meanwhile, you need patience to grow your business. Good point. All right. Okay, so I just want to circle back to what Brian was talking about. I I think these are two very key reasons. One, in using the purpose of the loan being something to earn you additional income, and two, preventing you from incurring additional expenses. The second point especially is something that I think there's this on social media, there's this notion that yeah, some people are buying assets while some people are buying liabilities, and a car is a liability. I kid you not. I give a lot of credit to where I am in my career right now, to my mother letting me drive her car to work when I was doing my national service. Because 5 a.m. I'm in the office. 5:30 a.m. I'm in the office. In fact, it's panning the audience now. When I moved to Damsel, my second role in my work, there was one comment he made. On when he's on his way to the office and he needs something done, he knows he can call me and he can rely on me to be there. That is something that not a lot of people could afford that luxury of, and it has set me apart many from many of my colleagues well ahead of time, right? And of course, I didn't go screeching with the car and all that. Eventually, I also got my own, right? And so that's something that I think you can consider. In fact, it may not even be a car, right, to move you to and fro. So in my situation, for example, I was living in Abukubi going to work in Ridge. So when I didn't have the car, I had to join the 4:30 bus all the way to Accra. That one express, sit to the market women and things. It reminds me of another colleague when Brian talked about fish. He used to complain that by the time he gets to Accra Central from Kasua, Charlie, he and the fishmongers, they are sitting by him and his whole shirt. He can't even wear his jacket in the mornings. So anyway, I digress. So there was this point when I was like, you know what? I had one Friday night when there shouldn't be traffic. There was so much traffic, it had rained. I go home around 11 p.m. And that wasn't the day that I had intended to go home early, to go home late. So I vexed. And I was like, you know what? I'm just moving out. I would find the money to do this. For some people, they may have to take a loan to do this first rent advance. But if you think about it, you move from a place like Abokobi to a place like Adabraka, Asylum Down, those areas closer. Yes, you'll be paying rent, all right. But now your career can have that opportunity to grow even faster because you can be more punctual to work. It's in your control. You don't get to the office angry with anyone for not picking you up at a junction, or for some trotro mates disrespecting you or haggling at the bus stop with somebody. Like, you can get to the office. You have 1 hour ahead of time. You read newspapers, you read the news, or you start taking a course or something. 30 minutes every single day. I think we spoke about this last week or the week before. Just that 30 minutes every single day, what it can do to your career, amazing things. So yeah, don't shy away from a loan if it would move you closer to your main purpose. All right. Okay. Great. Is there anyone who wants to say anything before we get to some of the technicalities? You know, we want to talk more about the terms and conditions. We all know that loans, yeah, you borrow and then you have to pay back. So let's get into the technicalities. But Mimi, you want to say something before we go on?
Yeah, I said that I just wanted to highlight that the key word is opportunity cost. And so not just the economic cost, but other considerations. And I mean, these stories just reminded me of those long queues at 37 and Charlie. Like, I can't even like imagine going back to that with like my the way my life is right now. It's so inconvenient. However, I think that in taking loans for example to offset a cost, I think we have to be strategic with that. So somebody will take a loan for a car because they want to bid their trotro life goodbye, which is okay, taking into consideration all the things we've spoken about. But then you go and buy a four-wheel drive that maybe today I heard the full how much it costs to fuel some cars, and I'm like, what? That's somebody's salary just to fill the tank. you know, and you go and buy this big car, and you are spending all your income on fuel, maintenance, oh, baba, and I had a situation like that. I actually know somebody like that. He took a loan to buy a car. There were two people. Unfortunately, he was living like so far away from the office and was spending a very significant portion, if not half of his salary, on fuel. And I thought it wasn't a very wise decision. So I think that if you're going to do this, you need to be strategic about it. You are taking a loan to offset a cost. Make sure it's doing that. So if maybe your first car that you're buying, it can be a smaller car, a fuel efficient car that would help you to maximize the benefits of this transaction you are taking, so that you have more room in your budget for other important things, then cool. But if you are going to take it just for flex, and you are in an AC car, you are in an aircon car, but you are sweating, like someone who said she was in a Pathfinder, but she had just 30 CDs to her name, then I feel like that is an issue. So how you go about it, to me, it's important. So it's not a yes or a no. It's not a definite response, but it depends on the situation.
Hey, Mimi, please, I'm here. Me, I don't have any cash on me. Am I in a bad situation? I have
I
money in
didn't
my
say
bank account, but I don't have cash.
no. She said she had 30 CDs to her name, and you say
To her
like
name. Hey,
yes,
okay.
to
I,
her name.
uh,
So that's when you are sitting in the car, but and only
ah,
you understand. A friend was telling me she earns 3,600, she earns 1,200 on fuel. And it's because, and this was before these increases. I think this was about 2020 December. So I'm sure by now, dear. And you know, you could just get a small car. You still move from A to B. You won't fight with anyone over trotro. The small car to economical fine. Like, I think sometimes because of ego, peer pressure, we end up getting ourselves into certain things that we shouldn't have gotten ourselves into. I think when you reach the four-wheel level, no one will tell you that you've gotten there. You know. So for me, I think if we're going to take a loan for this purpose, we should be more strategic about how we do it. Yeah.
Charlie, that's a punchline. When you reach the four-wheel drive level, no one will tell you to buy it. In fact, your company will buy it for you as company car.
I know, right?
Good one there. Jenny,
Okay,
Jenny, go
so
ahead.
when Mimi said just drew my attention to something, Brian, you can tell me if this is true. So apparently, in the universal banking space, when you make it like as a young person, so it's mostly the guys. Okay, so as a young man, when you
Share.
when you're buying a
Now.
car, you buy a Civic, and then they'll line it up, and then they'll say the Honda Civic boys, and then they'll be happy. So I know somebody who wanted to be part of the Honda Civic big boys. He went for a loan, went to buy a Honda Civic. Apparently, so I don't know about the fuel consumption, but apparently he said he's struggling. He's really struggling with the car maintenance, fuel, everything, just to chill with the big boys. So sometimes you really need to check your ego and then peer pressure. Thank you.
Yeah, Jennifer, I just
Nice.
wanted to say that, like, for me, for example, my company, you see somebody driving some kind of car. Yes, they are buying fuel, but they are not, based on the arrangement, they are not paying for maintenance. You get it? People have certain arrangements that you may not know about. As Elikem said, some CEOs and some big shots, well, depending on the company you are in, they get fuel coupons and all sorts of things, and you'll be competing with such people when all you get is your salary. So I honestly think that we should just be a bit careful about these things. When we are making decisions, let's ask ourselves why we are making those decisions.
Mimi, because you drive Honda Civic, you had to respond.
Oh no, me, my car is
Yes.
even small. I'm talking about, like, if you come to my office, what you will be thinking in your head, and what you are thinking is what is not it's not the truth. It's just based on, you don't have the full details. Do you get what I'm saying? You don't have the full details.
Yeah.
Because maintenance is being done. I remember when I was doing me maintenance, just deborn me. Like, why should the car get small? What you call it? You go and follow this person. I remember a close family of mine bought Benz because his good friend bought Benz. After he bought it and Charlie, the maintenance and the rest, it's a different. So now if you even give him Benz, I'm sure he will even take it. So I'm just like, let's ask ourselves questions. Yeah.
Right. That's a good one then. So guys, Mimi said, ask yourself questions. Yeah. Is it pressure? Do you want to chill with the big boys? Be mindful before you take that loan. All right. Okay. So let's get into some technicalities. Brian, I have some questions for you, and I've heard
Sure.
certain terms, and you shared some information with me on what's the kind of information that would be requested for if someone wants a loan, and the kind of terms that will be given to the person. And I saw something there right close to the top, fees. What's up with fees? I want to take a loan. Just give me the loan. Let me pay my interest. But now the fees are there, and then I hear that if I ask for 100,000 or even 10,000, I'll end up with just 9,500 or 9,000. But I'll be paying interest on the 10,000. Charlie, what's up? What's up? Please help us understand what's going on here.
Okay, so I'll start by distinguishing between the income the bank makes on the loan and then the fees that the borrower pays to the lender. The lender in this case being the bank. Forgive me if I'm being biased, but I work in a bank, so most of my inferences are going to be based on a relationship between a commercial or universal bank and an individual borrower. Now, as Elikem rightly said, you may request for 10,000 CDs. At the end of the loan processing, you are credited with 9,500, and you'll be wondering, this is not the amount I requested for. The bank has stolen my money. No, the bank has not stolen your money. Now, before the loan is disbursed to your account, we give you an offer by means of an offer letter with terms therein. One of the terms is, well, I can speak for the institution that I work with. You pay two different kinds of upfront fees. One of them is a processing fee. The other is an insurance fee. So the processing fee, as the name implies, is just a one-off upfront payment that you make to the bank for to cater for the cost of processing the loan facility on your behalf. So you may not see it as a rightful deduction the bank has made from your account, but then there's a purpose for it. For instance, it is one of the regulations from our regulator, which is the Bank of Ghana in our industry, that you run a credit bureau check on a customer's credit history before you lend to the person. The credit check helps you to know the kind of person you are dishing out your money to for the foreseeable future. If the person has a bad credit history, you run the risk of losing the money you are investing in the person. If the person has a good credit history, it gives you confidence that this person is going to return the money that he has taken from you. So we have to, by law, we have to make some of those checks. And it's not for free. The bank pays the credit bureau for having access to some of this data. So that is an example of one of the costs, and one of the costs that may not be directly understood by the borrower, but then it is necessary for the lender to incur that cost so that we know that we are making the right decision in lending to you in the first place. So a cost like that would be associated with the processing fee that you are paying. And mostly the processing fee and insurance fee, they are a percentage of the total loan approved for you. So most often it's not a very huge amount. It's within the range of 1 to 2% of the total amount that has been approved for you. to put that into context, if you are borrowing 10,000 cedis, and you are supposed to pay a processing fee of 1%, so that's about 100 cedis, if my math is correct. That's about 100 cedis. The second upfront fee you pay on your loan is the insurance fee. This is one area that my clients fight with me all the time over. They don't understand why we have imposed mandatory insurance on a loan that they are borrowing from us. They feel once they borrow the money is given to them. It is for them to do as they please with. It is not the bank's business to determine how they repay the money in the event of any casualty to them during the loan servicing period. That's also a wrong notion. It is the bank's business to know how you are going to pay back the money, because the bank didn't give you money from its own coffers. The bank borrowed money from depositors to give you the money for your future use. So when the depositors come calling on their funds, and because touch wood, maybe you are no more, or you've had a permanent disability, you passed on or something, the funds are not available, the bank is now exposed. So the bank has to look for money to repay its depositors. So one way of mitigating that risk of loss to the bank in the event of some of these things is for us to impose, I like to usually qualify it as a small fee on the total amount that you are borrowing from us, so that in the event of death or permanent disability, the total outstanding balance repayable to the bank is covered by insurance, whereas we don't have to now come and bother your family or your close associates or guarantors, whatever, to come and repay the outstanding balance you have on your loan. It is fully catered for by insurance. I mean, there are some terms and conditions in there, but then that is the large description of it. So I don't know if I've answered you, but those are the upfront charges that are made on a typical loan from a universal bank.
Okay, interesting. Just two quick follow-ups. So that means if I want 10,000, I should request for maybe 1,005 or 10,500 or 11,000, so that I make sure I get that 10,000, right?
Yeah. So again, I to my what I normally do is I advise the client that yes, you are requesting for such an amount, but after processing and insurance fees, this is the net that will be disbursed to your account. Are you comfortable with that amount? Will it be satisfactory to what you want to do with it? If fine, then we go ahead and process it as is. But then if you would need exactly 10,000, then I will run a quick simulation and tell you that in order for you to receive exactly 10,000, I will calculate an amount that you should request for, so that when we deduct the fees from it, you get exactly 10,000. That's what I normally do in my space. I believe most of my colleagues in the industry also do similar. So it's not a one size fits all. There are options. If you feel the net amount that you receive is satisfactory for you, or you can borrow or get some other quick means of making up for the difference without having to borrow extra money, then that's fine. But then if you at all costs need the exact amount, then the only other option would be to request for slightly higher. And then when they strike the difference, you get the exact amount that you requested for.
Interesting. Okay, good one. And the insurance part. So insurance, effectively, what I'm saying is to make sure that the bank can get their money when you die or there's a permanent disability. But I'm curious, would that also work for if someone runs away and we can't find the person? Can the bank go and collect from the insurance company?
No, that's the simple answer. No. The insurance agreement that we have with our insurers or underwriters on the loan facility strictly covers death or permanent disability. If the borrower runs away with your money, it's the responsibility of the bank to recoup that funds. We have different means of recouping the funds. There are departments in the bank who have the sole mandate or responsibility of coming to work every day to chase defaulting customers. That's their job. I envy them at all, but then some people are paid to come to work every morning to chase defaulting customers and try and recoup as much losses as possible. So there are means of mitigating losses, but insurance doesn't cover the client running away.
Interesting. I don't envy them either. Can't imagine wake up every day to go and judge people, holding people's waist.
Oh, they'll come and repo your car. Why?
Hey, those are some of the tactics. It's true. Charlie, then your nice Honda Civic, then they'll come and take it. Interesting. Okay, all right. Let's take another one. I've heard this term, reducing balance. Brian, can you shed more light on it? And technically, we in the investment side will say you're amortizing the loan. But I understand, at least from the layman's way, I understand it. If I'm making a payment of, let's say, 1,200 CDs every month, part of that goes to reduce the interest. It goes to reduce the principal amount, and then part goes to pay off the interest for the month. Can you shed more light on how that works?
Yes. So there are different arrangements for loan repayments by different institutions or different lenders. So as you rightly mentioned, we have the reducing balance, we have the fixed repayments, and then we also have another interesting one. It's not very popular in Ghana, but then it's called the balloon payment system. So let me start with the balloon payment. So you take a loan for a fixed period of time. At the early part of the loan, the repayments that you make are relatively smaller. And then as the loan progresses, then you start making larger installment payments. This is very common in most of the Western or developed countries, where the assumption behind that arrangement is that at the onset of the loan, the income you are earning may be relatively lower, but all other things being equal, it's assumed that as you continue working to service the loan, you will be advancing in your career, you'll be advancing in life generally. And so it's assumed that your disposable income will also be increasing while you are servicing the loan. So at the latter part of the loan, your installments will generally be larger than what you were paying at the beginning of the loan. Hence the naming of that kind of arrangement, the balloon payment. So it's like the shape of the balloon. At the bottom, it's quite small, and then as it gets further up, the payments are also increasing. It makes sense in some contexts where there are controls to cover that, but then trust me, something like that will not be popular at all in Ghana, because somebody has taken money from a bank. His daily headache anytime he wakes up from bed is how he's able to make his monthly repayment so that the bank doesn't keep calling him to harass him or embarrass him to make monthly repayments. And so he's not thinking of while the loan is progressing and he's hoping that he will just quickly finish. That's the time that his monthly installments will rather be increasing. It's not an interesting idea typically, but then it's one arrangement that is available for those who qualify for it. We also have the reducing balance method, where, as Elikem rightly narrated, the monthly installment as the loan progresses goes to reduce the capital portion of the monthly repayment. So, for instance, you take a loan where you are servicing a monthly installment of 1,000 CDs. Now, on the face of your account, every month, the bank is deducting 1,000 CDs from your account, but then the principal component of the money that you borrowed will be reducing gradually as the loan is progressing. So, in the first month, you pay 1,000 CDs. Out of that 1,000 CDs, maybe 80% of it goes to service interest, 20% goes to service the principal. Then the following month, you pay the same 1,000 CDs. This time, the interest component reduces slightly to about 70%, the principal component increases to about 30%. Now, if you notice, at the end of the day, both percentages will still add up to 100%. So you, the customer, are paying a fixed amount, but then in the books of the bank or in the ledgers of the bank, the capital is reducing as the loan is running. It gets to a point where on the last record of the amortization schedule, the balance outstanding becomes zero. And that's the point where everybody will smile because they know they have exhausted their monthly repayments and they can go back to having their full disposable income. And also, we have the simple loan calculation method. I don't think it's quite practical nowadays, but then you just borrow the loan at a simple interest calculation. They tell you are paying 30% per annum, and so you took 10,000 CDs. At the end of your repayment, you are going to end up paying 13,000 CDs because that 3,000 extra is the 30% income on it. The loan is not typically amortized like the the reducing balance method. You just agreed that you are borrowing this amount, you are paying back this amount with interest. They divide it up for you for the number of months that the loan is given to you, and then you make those monthly installments until the term of the loan is due. So those are the different arrangements that we have in loan repayments.
Okay, interesting. Brian, so okay, let me let David ask his question and I'll come back. So David, please go ahead.
Brian, there's another form of payment that I don't think I heard you say, and I wanted to just find out if it's something that is offered in Ghana, and that's the interest-only portion of it. People typically do it when they're getting a mortgage on like an investment property because they know that the property is going to appreciate in value so much that when they get the loan, they're only paying on the interest, and they're hoping that maybe after a certain number of years they can sell the property at a considerably higher price and then just pay off the loan. So during the term of the loan, all they're doing is just paying off the interest and nothing goes to the principal. Is that something that's offered in Ghana at all?
Okay, so I understand the concept you just narrated. Myself, I'm not very familiar with it because the institution I currently work with, we don't offer such an arrangement. But I'm sure definitely there are other institutions that offer long-term mortgage arrangements, and this will be one of the payment options. I mean, it makes sense that you service the interest. Definitely property prices are going to be rising, and so even if the bank repossesses the property, if you default, they are able to sell it off at a higher price than what you bought it at, and therefore the difference is going to make up for whatever loss they may incur. So it makes sense. I haven't worked any facility with that particular arrangement before, but definitely I'm sure it is available to the institutions that offer those particular tailored products.
Interesting.
Thank you.
I can just imagine this thing happening in Ghana. The way some Ghanaians like to misbehave, they'll just keep paying the interest. The one day they disappear, or even worse, they'll tell you that the hand that we used to collect the loan is not the same one we used to pay the loan. Mamma mia. Okay, all right. So on the back of what you just said, the fixed repayment, the one based on simple interest, does it effectively mean that if you take a loan from a bank, the better option would be for them to do the reducing balance instead of them doing that fixed payment? Is it that the fixed payment one with the simple interest is more like it's cheating you, it will be more expensive?
So typically the fixed payment or the simple interest method is not used at that level of universal or commercial banking. It's mostly used at the, let's say, the credit union level or the zonal associations, those who form smaller groups and borrow and lend to each other. It's easier to calculate. You know you took this amount. You know this is the premium that has been added to it. You know that at the end of the term, this is the total amount that you would have paid, and then end of story. There's not so much paperwork, not so much calculations involved. But then it's not practical in a typical commercial banking arrangement to have simple interest loans. Most personal commercial loans are amortized. So in the course of the loan, generally the interest component will be reducing, the principal component will be increasing. At the end of the day, they knock each other up, and then the balance runs zero at the end of the amortization period. But then you will not typically find a simple interest loan in an universal banking arrangement.
Interesting. Okay. Thank you. Thank you. So I encourage everyone, make sure that wherever you are taking the loan from, make sure that they are doing the reducing balance. And if they are not, at least you know ahead of time so that you don't go in there and unknown to you have to spend even more money to pay you off your loan. Okay, great. Let's take another question. And please, if you're on stage, feel free to raise your hand. We are talking about loans. If you're also in the audience and you are too shy to raise your hand, you can just send me a message and I would ask the question on your behalf. All right, great. So we've been talking about loans, and I think something is very obvious when we talk about loans: interest rates. So what amount of interest rates can I expect on a loan? What's reasonable if I walk into a bank? How will I know that this is fair or they are trying to cheat me or something? Any way for us to be educated on this?
Yes, so typically, I'll give you the market or the industry standard rates as it is. Currently, for salaried worker loans, the average interest rates you should expect will be between 15% per annum to probably 27% per annum, within that range. There are a number of components that will determine the particular interest that we should expect to pay on a particular kind of loan. I don't know if this is the avenue to speak on those differences now, but then typically for the range between 15 to 27. If you'd like me to elaborate more on what will cause you to pay a higher rate, I can do that. So you can let me
Yeah,
know.
I think you should because it's quite a wide range. That's 12% difference or 12 percentage points gap. So why is someone getting 15, someone is getting 27?
That's an excellent question. A very simplistic but excellent question. So in the institution that I work, we have, should I say, 3 or 4 broad category of personal loans that we give out. So we give out loans to we give out scheme loans. So scheme loans are typically what we will call institutional loans, where my organization has entered into scheme arrangements or contracts with other organizations and agreed that we would lend to staff of those organizations at an agreed interest rate, where an agreed interest rate is a rate that is determined by negotiation between the two parties. So, for instance, the bank I work at may have an agreement with Company X to say that any staff member of Company X who wants to borrow from my bank, this is the rate that is applicable to them. Now, Company X, depending on the size of the company, depending on the number of staff the company has, depending on their staff turnover. By turnover, I mean how often new recruits join the company and how often people exit the company. We have, I think those are the broad categories. And then also whether the institution is a multinational institution or it's a local institution also determines the rates that Company X staff will be getting. So that's the scheme loans, where we have entered into contracts with those companies that anybody from that company will borrow from us at this rate. Usually, the scheme loans have the lowest interest rates because the company is able to bargain using their staff unions, etc., and say that, yes, we understand that the general personal loan rate you give is so and so percent, but we want you to give preferential rates to our staff. Otherwise, we'll go to your competitor and do business with them. And in the environment that we work with, it's all about competition. So as much as we are looking forward to mitigating our risk and recovering our losses, we also have to consider that if we lose out on this business, the next institution is available to do it for them. And so we also have to cut down on our rates. So the institutional or the scheme loans typically have the lowest rates. Secondly, we have another product we call the relief credit. That's one of our marketing terms. It's a relief credit loan where we, the bank, have identified institutions that we may not necessarily have agreements with, or we may not necessarily have contracts with them to give staff of those institutions rates at an agreed rate, loans at an agreed rate. But then by the nature of the organization, the reputation of the organization, the staff numbers of the organization, staff turnover, we have done our own research and identified that these institutions, we do not have agreement with them, but just by observing their operations and observing some of these data from them, we feel we can give staff members of those institutions loans at a more favorable interest rate than we would give any other staff member of any other institution. So it's quite similar to the institutional rate, except that we don't have any contractual agreements with those institutions. We also have personal loans that we give to salaried workers who are paid by the government or who are paid through Controller and Accountant General's Department. That's the institution that runs the payroll for all government workers. So anybody who takes their salary through Controller and Accountant General, even if they don't bank with my institution, they qualify for a personal loan up to a certain credit limit based on by virtue of them basically taking their salary through CAGD. Usually the CAGD loans have a slightly higher interest rate than the scheme loans or the relief credit loans because there are some processing fees that we also pay to Controller and Accountant General to run the loans on their platform. So in addition to the typical interest rate that we give to staff who are paid by the government, because of those additional processing fees we pay to CAGD, we are also in the industry to make money. So we intend pass on some of those costs to the borrower by means of adding it to the interest rate. Also, there are other institutions that they may not be as reputable or we may not have them on any of our lists, but then just by nature of the individual borrower's credit history, we determine that we can do business with the person, but because we have fewer guarantees of getting our money back, we give them the money, all right, but then in order to mitigate or reduce our risk exposure, we slap on a little premium on the interest that they pay just to cater for that uncertainty. So that person may end up paying closer to 25, 26, 27%, whereas somebody on the scheme loan will be paying closer to 16, 15, even in some cases 14% per annum. So that's what's the term? That's what's causing the quite gap between both ends of the extreme.
Wow, that's a lot of information. This is good feeling. At least now it explains things and we understand it better. The last category, what did you call the last category of people?
I'm sure every institution has their own marketing or brand name that they use to refer to them. But then ours, we call it an exceptional loan. An exceptional loan or an exceptional borrower in the sense that typically we lend to organizations that we either have contracts with or we have identified those organizations that we can lend to them. But then these other borrowers, we first of all don't have them on any of our contractual lists. And also we may not have necessarily identified their employers or their organization as one of the reputable ones that we give loans to. But then when we analyze the individual borrower, we analyze his credit history, we analyze his relationship with the bank, etc. We feel, although typically we wouldn't have granted such a person a facility, by virtue of the individual's information they provided to us, as well as the credit checks that we do, we can still go ahead and lend to the person on an exceptional basis. But then they may end up paying a slightly higher rate than somebody from any of our other listed institutions.
Okay, great, great, great. So I have a question here, and it reads, for this last group, you mentioned that an extra interest rate is added on the loan to ensure that the person pays. How is the extra interest rate a motivator to get the person to pay?
Okay, so it's not necessarily to get the person to pay, but then to ensure that, assuming the person doesn't pay, the interest that we have collected, when we pull them together, we will be able to cut our losses. That's basically how a credit arrangement runs. You are giving money to a pool of people. Some of them will pay, some of them will run away with your money. That's the truth. But you slap an interest on the borrowers so that the extra interest you have put on those who are borrowing should cater for at least part of the losses you will incur from those who are running away with your money. It's not a very fair principle, but then it is necessary to safeguard the lender, because if our credit system in Ghana was as perfect, well, maybe perfect is not the word, but then if it was as efficient as what we have in other jurisdictions, I believe strongly that interest rates on personal loans shouldn't be above 10% per annum. If you go to America or you go to Europe and you tell them you have a personal loan back home and you're paying 10% per annum, everybody's going to look at you like, are you crazy? Because they don't have huge fluctuations in their exchange rates. They don't have huge inflation rises in the course of the year and all those other determinants of the premiums on loans. We have to suffer some of those things because of the inefficiencies in our market, and it all boils down to dishonesty. So, because some people will take your money and run away, everybody else has to suffer a higher penalty so that we can all pull together and cater for those who are not willing to abide by the rules and pay their portion of the loan. I don't know if it's clear enough, but then that's the principle behind it.
Yeah, it's very helpful explanation. And what you're saying, all of us suffering for the few who are dishonest and don't pay back. It's like quick loans. When we see on social media people making jokes about taking quick loan and not paying back, trust me, it's not a funny thing. We are paying for them. There's no free lunch. Someone has to pay for their losses, for them not wanting to pay the money back. And we, the people who are paying diligently, are the ones going to be taxed to pay. And I know you are the expert here, but if I also want to add onto this point, right? And the higher interest rate, I see it as it works like this. I could charge someone 10% for a loan. So 1,000 cedis, 10%, I'm expecting 1,100. And if we are to spread it over 10 equal months, you'll be paying 110 cedis every month. Someone, um, I see someone as higher risk because I don't know, I don't have a special agreement with the person's employer to make sure that their salary will pass through my bank, or even better, they will even pay me my portion of uh, my portion that should come as loan repayment before they pay the person that salary. All these arrangements are supposed to give me comfort, me as the bank, comfort that I'll get my money back. And I have agreements to make sure that I have that. So I'm more comfortable. But with you, I don't have all these agreements to protect my money and make sure it comes back. So I'll charge you 30% instead. So 1,300 spread over 10 equal months. So 130 cedis each. Every month, the person with the higher risk, the higher interest rate, every month I'm getting more of my money back. So that even if the two people decide that they won't pay the last 2 months payment at least. Or no, no, not the two people. The person paying 10% will stay to the end and pay that all the 10 months. That's fine. But the 30%, the person paying 30%, like as I was suspecting, the last month the person does some funny tricks with me. At least I would have collected enough of my money back, and I wouldn't be losing so much because I was taking an extra 20 CDs every month. So it helps to make up for that kind of loss if it happens. If it doesn't happen, okay, that's all good and well. But if it happens, this is my way of being protected. So there is it's this how it plays out whenever we say the higher the risk, the higher the return, right? So that in loan terms, there's the higher the risk, the higher the cost. We always talk about investing, so we say the higher the risk, the higher the return. But investing is the other way around. The return is a cost to you. So the higher your risk, the higher your return. Great. Thank you for these explanations, Brian. You were giving examples of current market rates, and you talked about salaried workers getting 15 to 27%. I'm curious, how about entrepreneurs or business people, self-employed people? Because I'm sure some of us here are in that bucket. How would it work for us? Oh, for those people who are self-employed.
Yes. So I really appreciate the simplification that you did on the point I raised earlier. So that's basically it. So um, if you are less risky, typically you pay a lower interest rate than somebody who is deemed to be more risky. That also applies to the question you just asked. Um, Generally, entrepreneurs are risk takers. They venture into a business in anticipation that it is going to turn out one way or the other. Now, for a salaried worker, I mean, there's some level of guarantee that at the end of the month, we are going to get some income from you so that we can use part of it to defray the outstanding amounts that you owe the bank. So there's some level of guarantee that every month we are going to get something, no matter how risky or not the individual is. At least his employers are going to channel his salary to the bank for us to take, if not even the whole amount, part of it every month. Now with entrepreneurship, so that in that sense, we are moving slightly beyond personal loans to SME and business loans, where we give you money upfront or we give you credit upfront with the promise that as you are running your business and making your turnovers, you start repaying us. Maybe we give you a few months moratorium, then you start repaying us. But there's a slightly higher risk associated with entrepreneurs or startups, for example, where I think earlier on in the conversation, somebody talked about borrowing to invest the money in a business that is not yet on its feet. In a typical arrangement like that, yes, some institutions will still lend to you, but then you end up paying a much higher interest rate. I think the range is between 27 to 35% per annum, if I'm not mistaken, for a typical arrangement like that. It's just because of the level of exposure. Mind you, the bank is giving you money, but then the bank is not giving you money from the directors or the individual staff's pockets. The bank is giving you money that it has taken from other depositors. And the depositors can call on their funds at any time. Somebody can come and do an investment with you for 1 year. After 6 months, he will come and say he needs his money back because he has an emergency. The bank will have to pay the depositor upfront. Now, if the bank has given that money to you and the bank doesn't have the confidence that you are going to return it per the agreed contract that you have, they will add an extra premium to whatever a low risk person would have been paying just to cater for any shocks if somebody comes that they want their money unexpectedly. You get it? So somebody in the SME space may and I'm using this word advisedly, may be paying a slightly higher interest rate than somebody who is going to be servicing his loan from his salary. Basically, because it is deemed that business is slightly more risky than having a fixed monthly income. So that I don't know if that answers the question, but that should be an explanation for it.
Yeah, it does answer the question. All right, that's great. Thank you so much. For me, I have just two more questions, then I'll invite the other speakers to ask any questions they have, and then we start looking to wrap up. When I was much younger, I used to hear about guarantor for loans. That is that does that still happen? And in fact, what is a guarantor? Do we still have guarantors for loans?
Yes, we do. So a guarantor typically is um, an affiliate of the borrower. What I mean by that is when you let me put it in context. So you, the individual, let's say Elikem, you've come to my institution that you want to come and borrow from me. I don't know you from anywhere, but I've checked your credit history, I've checked the institution you work with, etc. And I feel like I can do business with you. I can give you some credit with a promise of you paying back after an agreed period of time, together with the terms and conditions that come with our arrangement. Because I have not had a banking relationship with you before, or a borrower lender relationship with you before, I may seek for an extra guarantee that just in case I'm looking for you and I cannot find you, or I found you but you are telling me that you don't have any means to repay me, get me somebody who can stand in your stead, meaning that in the event that I cannot get all of my money or part of my money from you, somebody that I can walk to who will either help me to reach you to pay me my money back, or will support you in making the repayment. We have different kinds of guarantors based on the loan agreement that you have. But the guarantor is typically somebody associated to the borrower who may stand in his stead when it comes to recouping or servicing the loan facility. The level of liability that the guarantor is exposed to depends on the kind of loan arrangement that the person has with the borrower, with the lender, sorry. So the guarantor may be fully liable for the repayment of the loan, or may just be a source of information for the lender in case he's unable to reach the borrower directly. So that's how come sometimes when you are signing a loan offer letter, you are asked to bring along a witness, somebody who will also pen his signature on the document to show that he is a witness to the agreement. Somebody like that may not be liable in case you abscond with the bank's money. That person may not be liable to refund the money, but per the agreement, the person should be a source of information to help the bank trace you to get its money back. We also have other arrangements where the guarantor will sign that he will be liable for at least part of the repayment of the facility in case the original borrower is unable to service the loan as agreed.
Interesting. So I guess this is a lesson to us, not only in terms of if we want to take a loan, but if someone wants us to guarantee a loan, we need to be aware of the implications of this. So that if you budgeted that you are saving to go for a trip to Dubai or to Lumo, then you better make sure that you don't go and guarantee a loan that will eat into your budget too much. Okay, great. Brian, and my last question is also related. Collateral. I hear that term also. What what do banks take as collateral, and what does it mean? What are the implications? Does it mean I lose my property entirely until I finish paying the loan?
Okay, so a collateral in a loan arrangement is typically a security that you share possession or ownership of the security with your lender, at least for the duration loan, so that in the event that you are not able to continue the loan repayment as agreed, the lender or the bank in this case can fall on that security to recoup at least some of its outstanding indebtedness that you have with the bank. So a typical example would be somebody who has a property. So maybe somebody has a car. He has come to borrow from the bank and he's using his car as a security, or he's using his car as a collateral for the loan. It doesn't mean that while you are servicing the loan, you go and park the car at the garage of the bank and you don't have access to it until you finish paying the loan. No. But then you share ownership of that property with the bank, at least for the duration of the loan. The technical term for that is the tenor, for the tenor of the loan. So that in the event that you either abscond with the bank's money or you are unable to repay as agreed, the bank has the legal right to recoup some of its outstanding money with you from probably the sale or disposal of that asset that you used as a collateral. As to whether you are going to lose the property if you don't pay, legally, the bank is only entitled to the value of the unpaid amount with you. So let me put that in context. You borrowed 30,000 cedis. You gave the bank access to your car, which is also valued at 30,000 cedis for the duration of the loan. Maybe you service the loan for about half of the period and your outstanding balance with the bank, or your outstanding balance to pay the bank, is, let's say, 15,000 cedis. The bank still has access to your vehicle, which, for argument's sake, let's say, is still valued at that same 30,000 cedis. It doesn't mean if you are unable to pay the remaining 15,000, you have lost your car valued at 30,000 and the bank has taken your property. The bank is legally entitled to trade off or to sell the property, in this case the car, and recoup its outstanding 15,000 from it. The difference therein will have to be reinstated to you, or will have to be repaid to you. So if you are looking at it in terms of the value of the collateral, the bank is only entitled to the outstanding unpaid amount from the sale of your collateral. Whatever proceeds that there may be after still belongs to the original owner of the security. So that
Interesting. Okay, at least that gives some comfort. You don't lose the entire thing. Okay, great. I know that I said that was the last question, but you just got me thinking about something. There's a follow up. Default. I just assumed everyone knew what default was. So what does it mean when we say someone has defaulted on a loan, and what happens?
Okay. So that's the unpleasant part of any borrowing contract or any borrowing agreement. And it's not only individuals who default, even big businesses, even the huge multinational companies that you see with all their beautiful branding and marketing, a lot of them tend to default on some of their credit facilities. But anyway, I digress. So a default is basically a failure to meet either an installment payment or an outstanding balance settlement. So depending on the kind of loan that you have taken from the creditor or from the lender, if you agreed that every month you are going to be servicing, maybe you borrowed 10,000 cedis, every month you are going to be paying 1,000 cedis until the loan is exhausted. You pay for 2 or 3 months and you feel you are unable to continue making payments, so you quickly channel your salary to a different bank so that when the money comes, it doesn't come to the original bank you borrowed from. It goes to your new bank and you can have access to your full money. You have defaulted. Default is defined by the date that you agree to make repayment. Once the date passes by and you have not made a payment, technically you have defaulted. Default is not always the fault of the borrower, though, especially in the case of salaried workers. The agreement you have with the bank is that when your salary comes into the account, the bank will take its portion and then the rest is left for you. In the event that your salary doesn't come on time, or if, for instance, you are a government worker and your salary delays by 2 or 3 months, it's not typically your fault that you haven't made repayments. You are also relying on funds from your employers and the funds have not come. So to the bank, you have defaulted, but then we have arrangements for dealing with such situations. But basically, when you promise to make repayments on a particular date and the date lapses and you don't pay, you have defaulted. Now, as to what happens to you when you default, usually there's I don't know whether to call it a grace period, but there's at least some leeway for you. At least you have up to a month after the original agreed date to recondition your loan or to make sure that you settle any unpaid installments, after which then the bank will start calling you and sending you letters and visiting your place of work and etc. And that aspect of that's mostly at the point where the relationship degenerates, where it becomes messy. Sometimes it ends up in legal issues. You have to start going to court and whatnot. It's very unpleasant. But then it comes with the arrangement. There are a lot of people who default, some unknowingly. Maybe money came into his account. He had to make payment to somebody else, so he has issued a check to somebody. The person presents the check, the bank honors the check, and the money is cleared from the account, only for him to realize that he has a loan installment he was supposed to do. So once the bank calls them, oh, Mr. So and so, we realize that you defaulted on this particular installment. Oh, they'll just quickly apologize, issue a transfer from maybe another account, or come and pay cash or whatever, and then the loan is settled, and then the banking relationship continues like that. There are some people who also deliberately default because they feel they can cheat the system, or because they feel they are wiser than everybody else. So they know that they have an obligation to make monthly repayments for their credit facility, but they will deliberately withhold the money. The bank will chase them in anticipation that the bank is just going to grow tired and forget about it, so that they just go away. But then it also has implications on your credit history, especially when you are going to borrow from another institution. So yes, that's basically it about defaults.
Okay, that's great. The people who want to cheat the system, it will affect your credit, history when you go to a different institution. So be advised. Okay, it's been a good conversation so far. I've learned a lot of things that perhaps I didn't know and I needed more clarity on, and I'm sure everyone else has. Especially considering that we have people who have stayed on faithfully to listen to us throughout this time. Thank you so much for spending your time with me and with the team. So I'm curious, does anyone else have any more questions for Brian? We have been talking about taking loans. So any questions? David, please go ahead.
Yeah, so Brian, I have a million questions for you, but for the sake of time and also I don't want to sound too ignorant, so I'm just going to keep it to one. When you were talking about the government workers, you said something about your financial institution having some kind of arrangement with, I forgot the term that you used, but I think it was pretty much people who get paid by the government. And also, you said something in there that their rates tend to be a little bit higher. Is that because you guys are making arrangements, or you guys are taking into account the fact that the government tends to delay in paying those people, or why is it that those people, their rates tend to be a bit higher than normal? And if it's not that, then what's the incentive for them to get a loan through your institution?
Yeah, thank you for that observation. I was actually hoping to clarify it. It escaped me when I was explaining. So the issue with that is a multitude of issues. So firstly, I forgot to mention with my institution, we can still lend to you even if you are not an account holder with the bank. Once we have proof that you are paid through the Controller and Accountant General's department, which is the system that pays all government workers. Once you are paid through that channel, the bank is comfortable to lend to you. The issue with that and how it relates to the interest rate is, first of all, you are not the bank's customer. You don't channel your salary through the bank's account. So in terms of information and access to you, there's some limitation placed on the bank. In the event of default, the bank has to basically put in extra effort to be able to reach you in case we are not able to get our money from you. So that aspect of the risk naturally would slightly increase the interest that you would pay compared to somebody that we already have a banking relationship with, both the individual as well as their employers. Also, I mentioned that there's a platform that we use to process the individual loan facilities for those who are paid through the Controller and Accountant General. And because it's a software that we employ to run that particular arrangement, and it's not for free. We also have to pay the developers. We have to compensate CAGD for giving us access to that software that we use to run processing of the loan for those of them who are not our customers. And as a result, we may have to pay an extra 1 or 2% of the amount borrowed to CAGD as compensation for having access to their platform. And trust me, the bank will not bear the full cost of that alone. Some of it will be passed on to the customer. And the means by which it will be passed on is by adding it to the interest that you pay. So if you are not a customer of the bank, but you are still interested in borrowing from us, that may be a small price to pay in addition to the normal interest that you will be paying. So this and a few other factors would constitute reasons why the rates may be slightly higher. When I say slightly higher, it's not drastically higher. For example, if a typical interest rate for a personal loan would be about 20%, maybe if you belong to that category of the CAGD customers, you would end up paying probably 21 or 21.5. So it's not like just that category will force you to now be paying interest rate of 26 or 27%. No, it's just a slight difference. But in real terms, it is generally slightly higher than other category of borrowers.
Okay.
I hope that explains it.
Yeah, the reason why I was asking that is that, and again, I realize the fact that we have different banking systems and different banking arrangement, but over here, the banks that have those kind of arrangements with the government, they tend to lend at lower rates to those people than they would to regular people who don't work for the government. And that's because with that arrangement, if you default, it's much easier for them to garnish your wages and claw back whatever money it is that they loaned you than it would be for a person that worked for a private company. So that's why I was asking that. Thank you.
Yes, I appreciate that point as well. But then, as I alluded to earlier, it all boils down to the efficiency of our systems, our credit systems, etc. So it may be working perfectly fine. I don't know exactly where you're speaking from, but then I'm assuming that the credit system will be much more efficient than what is in Ghana, and it generally affects all our interest rates, not just those for the government workers. Also, We also have government workers who have salaried accounts with us. They channel their salary through our accounts and we lend to them. So they have a preferential interest rate compared to those who don't have a banking relationship with us at all. But because generally our interest rates are lower than what they would get on the market, they would still like to borrow from us. Then, and that's the price they pay for it.
That's great. You know, David is in America, so there the system works
Yeah,
too forcibly.
the system is
No
working.
off
I can
days.
tell.
Mhm. Yeah.
Thank you for the
Okay, great.
explanation.
Great. Thank you, David, for that question. Okay, all right. So, I guess we can wrap it up. Jennifer, do you have any closing remarks before we close this down? So we hear from Jennifer, then Mimi, and David. If you still have more, then let Brian have the last but one word. So, Jenny, you can go ahead.
Okay. So, thank you, Brian, for this scintillating session. I think I've learned that there are a lot of nuances that comes when you are taking loans, especially with the processing fee and insurance fee and all of that. So I have to come for the simulation so that I know the amounts that I'm supposed to take, and so that you don't get surprised when you go for, let's say, 10,000 and then you get less than that. Thank you for that. And also about the differences in, like, what makes up the loan rates, interest rates that you are charged. So I've really learned a lot. Thank you very much. And I hope that we all arm ourselves with this knowledge and take better decisions. Yeah. Thank you.
Thank you, Jenny.
Great. Mimi, how about you? Any final words? Okay, I think Mimi is not in a position to speak at the moment. Okay, David, how about you? Perhaps
Oh,
advice to your brothers and sisters back at home.
my advice is that if you're guaranteeing a loan for anyone, please don't do it based on emotions. Do it based on facts. If the person defaults and per the arrangement, you are liable for that loan, it is not a pretty picture. Trust me, I've been there. So please, do it based on facts. Take emotions out of it. Thank you.
Charlie, when experience speaks, you can feel it. You can feel it. Okay, great. Thank you, David, for that word of caution. Brian, any closing remarks for us? Hi, Brian.
Yes, can you
You
hear
are
me?
speaking, you're muted. Yes, I can hear you now.
Yes. So thanks for the opportunity to share with you. And I've also learned quite a lot from the questions that you've posed to me. I feel basically borrow when you need it, or borrow when the circumstances are good. Most importantly, borrow when you have the means of repayment. Don't just borrow because everybody else is doing it, or you also want to show off just like your friends. Like the example Jenny made earlier of the Honda Civic boys. I mean, we are laughing about it, but then it's real. It's real. It may not be Honda Civic, it may be something else, but then it's real. Don't just borrow because you are in a circle of associates and everybody is doing it, and so you also have to feel you are part of that class. Trust me, you may end up regretting, because when it comes to maintaining that level of um, opulence that you are displaying, you end up paying for it. I've had experiences with so many people who borrowed not necessarily because they needed the funds, but because they felt it was freely available. And so they went in for it. And then a couple of months into it, they realized that it's not a pretty picture. I think one of the speakers earlier alluded to an example like that, where you borrow thinking that it's going to be one way after a couple of months, only for you to realize that it's not as you planned earlier. So as much as I sell loans, and so as much as I want to meet my targets and I want to sell to as many customers as possible. Sometimes I have to be honest with myself. If somebody comes with a particular situation, I put my targets aside and honestly advise the person that as much as I want to excel at what I've been asked to do, I feel personally that if you go into this contract, you are going to be worse off. So I'll rather suggest that you do it this way instead of this way. I mean, basically, that's the little advice that I would like to leave for anybody. It's good to borrow. It's good to borrow to either earn extra or to reduce your expenses. But then don't just borrow because it's there. And also borrow with a plan of repayment. Borrow knowing that this is how you plan to service it. Otherwise, when it gets to the point where we start writing to you and we start involving the lawyers and we start visiting your places of work, all the embarrassment, all the tears, all the legal brouhaha. I mean, I don't think it's worth it. So plan ahead before you borrow. And also, I'd like to give a shout out to Jennifer. She's been a very close friend of mine since university. She was in my class, very smart, young lady, and she inspires me a lot. So, a shout out to Jennifer and all the new people I've met just here. I'm grateful to be part of this meeting. So, thank you.
Vibes on vibes. Vibes on vibes. I was going to say, tell Jennifer that it seems Brian deserves some all for putting aside his target.
This one, there, Brian, you deserve all. Well, thank you.
Welcome.
Okay, great. Thank you so much, Brian. I have really enjoyed this session. Yeah, and I know a lot of people have had something to think about. At least some people have paused. Douglas, for example, he's finished school and he started making some money. He's already moved out of home. Not exactly living on his own, but he's moved out. He's on the way out. I'm sure where he is, he's seen people getting paid well. When he finishes national service now, and he cashes in that first bonus check or that first proper salary, Mama Mia, I'm sure he'll start thinking maybe I should get a loan. So at least we've started priming his mind. He gets sense all right, but Charlie, a lot of people in the bank too get sense, but peer pressure is on a different level. So at least we are helping to prime different people. So I'm really glad we have these conversations. Speaking of these conversations, there's more. We have recorded sessions, so check out the replays on Clubhouse. Just go to the club's page to check out the replays. Follow us on social media. We also have the book reviews. We are reading The Intelligent Investor. So Mondays at 7 p.m. Join us on YouTube. You don't have to read the book to join us. Just come listen to what we are discussing, and you may pick up a lesson or two. Since we restarted in February, it's been mainly Jennifer and I on stage, but henceforth we want to bring one more person to join us at a time, different people, and hopefully we hope that it will get to a point where it becomes like what's it called? Jennifer, what was the example? Like something karaoke, carpool karaoke. We can bring celebrities. Jennifer has some celebrities lined up for us in the future, so we hope we can get to that level and they will come up. But someone like David, we know that Who Moved My Cheese, David will come on. Another part when we are reading Who Moved My Cheese also, I know Danielle would also like to get in on that action. We are having Mimi on Monday to discuss chapters 6 to 10. So come and listen to what Mimi thinks about the book on Monday. So we hope you all join us on Monday at 7 p.m. And yes, Thursday, 7 p.m. Every Thursday at 7 p.m. We are here on Clubhouse having these conversations. And next week will be about mortgages. So similar to loans, but this one geared towards home housing. So I'm sure we are all young thinking about our houses. So or what real estate investments we want to do. So come and let's learn about this and make sure that we are making good decisions. Thank you all so much for your time. Thank you, Brian. like I really appreciate this one. This one, you do everything for us. So thank you so much, and I wish you all a pleasant weekend.
Thank you. Thank you for having me.
Great. All right then. Bye.
Brian, that's you.
Thank you.
Thank you for taking the time to listen to our thoughts. I hope you learned a thing or two and start practicing. Don't forget to follow us on Twitter, Instagram, Clubhouse and Facebook, and subscribe to our YouTube and podcast. Do tell a friend about Money Convos so we all become wealthy together. Talk to you soon. Bye.